There's never been a better time to subscribe to PairTrade Finder Pro and use our top 30 US equities pairs to learn to pair trade. And why do I say that? Well, let's take a quick look at this chart here. This will show you the performance of the three main US indices over the last year. We're looking at S&P 500, Dow Jones, and Nasdaq. And we've had a nice smooth year all the way up until February 19th, which was an all-time high on the Nasdaq, and then we had the crash, and you can see that the indices crashed very substantially, including the Dow Jones crashing up to 30% peak to trough, and then we've seen that those have now recovered about 15 to 20%. So incredible volatility over the last 2 months, and what does that mean for us? Well, as pair traders, we love volatility. And as a long-only investor, you're probably smarting. You're saying, darn, I didn't get out in time, or maybe you did, and you're lucky. Well done. But if you didn't, you're down 30%, come back 15%. Now you're nervous. Should you be in equities or not? And when that happens, we like to look at an indicator that we think is very instructive, and that's called the Buffett indicator. And the Buffett indicator is Warren Buffett's preferred indicator for a look at the general market valuations to try and decide whether it makes sense to be allocating money to the US equities indices or perhaps not. And very simply, that indicator is the Wilshire total market cap, market cap in the United States over the US GDP, nominal GDP. And you can see in this chart here that here it starts in May 30th, 1971, all the way till today. And for the green line is the GDP, and the blue line is the market cap of the entire market in the US. And what you can see is that, in times of exuberance, that's well above the GDP growth, and in times of crashes, it's well below. And clearly, what you want to do is if you are looking to allocate money, you want to allocate when this ratio, the ratio of total market cap to US GDP, is low. Somewhere, you can see it's fallen at its lows. It's at about 33%, and at its very highs, which was just recently in March, it's up to 150. Well, now, so if you're going to allocate money, the idea is to allocate it when it's somewhere between 33 and 75%. You're going to get much better returns going forward on an average basis. So what are they saying now? The stock market is significantly overvalued as of April 21st, and the historic ratio of total market cap over GDP is 126.3%. It's likely that the market will only return 0.3% a year from this level of valuation, including the 2.11% current dividend yield on the index. So what does that tell you? What it says to me, at least when I try and interpret this data, is that it's likely that we're going to have more market volatility. Because despite earnings cratering and the massive stimulation packages launched by the Federal Reserve to try and save this overvaluation of the markets, it looks like there's going to be a lot of tension between those two things, and we're probably going to see a lot of volatility. Well, what does that mean? Well, why do we love volatility as pair traders? Simply put, I'm going to take you through a report here, just one chart. And this is a 16 February 2016 pair trading profitability report by Deutsche Bank. Okay? And this is a chart that they have in the back of the report. I'm going to try and zoom in a bit here so it becomes a lot clearer. So what are you seeing in this chart? They've used a pair trading strategy, very simple, 2 entry stretch, 0 exit stretch, and they've overlaid on that a fundamental screen like we do, and then they've run that back from April 2002 all the way to April 2015. So this is a 13-year period. This is a self-financing portfolio, i.e. no leverage. And what do you see? Well, the blue line here is the VIX, and the red line is the monthly return on that pair trading strategy. And this is overlaid on the VIX for the same period. So what do you see? Well, the first thing I notice, remember this is not leveraged. So, I notice that the average return here looks to be about 0.8 to 1% on the pair trading strategy without leverage. So, we can lever that 2 to 3 times as it's a very stable strategy. And the other thing I note is that in that 13-year period, based on their research, there's only been 4 negative months. And that's what we mean by consistent profitability. What this research suggests is that a pair trading strategy consistently applied in the markets leads to consistent profitability. That's a big takeaway from this chart. The other big takeaway is that every time the VIX spikes, so this blue line, every time it goes way up to, the VIX is on the right-hand chart, right-hand axis here, 40, 50, 60. What do you see happens to the red line? Well, the monthly pair trading profitability also spikes. So here the VIX spiked to about 40, and monthly profitability went up to 1.5%. Here you had the major market crash in 2008 where the VIX spiked up to 60 like it just did over the last 2 months. And this unlevered pair trading strategy delivered about 7.5%, 8%. Okay, so with leverage more than that. And that foots nicely with the performance of our top 30 US equities pairs in March of this year. So while the markets were crashing, the live trade signals called by those March 1 vintage top 30 US equities pairs delivered 11.9% for the month of March on account equity using 4-to-1 leverage. Okay, so that sort of foots with exactly what happened in 2008 with this strategy's monthly profitability. And again, here you see a spike in the VIX at the end here, and you see a spike in pair trading profitability as well. So that's just a quick view of why we love volatility as pair traders, because it juices pair trading returns. What I am going to do is just quickly show you the new top 30 US equities pairs. We launched these to our subscribers. They were able to download them as of April 15th, which was last Monday, I believe. And since then, there's been one exit, which is Fifth Third Bancorp and WTFC. So that was an exit yesterday. Let's just take a quick look at that trade. What happened? Well, on the 16th of April, so the day after we launched the new top 30, there was an entry called at a 2.9 standard deviation stretch. And then 1, 2, 3 market days later, the exit was called at a 0.95 exit stretch, and the trade delivered $677 in 3 market days on a $10,000 leg nominal. If you were putting up $4,000 of account equity to hold that trade, that's 5-to-1 leverage, you would have made $678 on $4,000. That's almost 17 or 18% in 3 market days. And that's the entry right here, and there's the exit, which just happened yesterday. Anyway, that's a quick look at the new top 30, why we love volatility in pair trading, and why we think there's never been a better time to subscribe to PairTrade Finder Pro and learn to pair trade US stocks. Happy trading, everyone.